Good morning. It's Monday, the 19th of August, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take for today. 1 of 3 smartphones, or close to 34% of smartphones bought in India, are financed through loans and thus EMIs. Now, that's a lot considering some 157 million smartphones will be sold in India this year, or thus about 50 million smartphones will be financed. Now, that's good news for the loan givers, including both banks and non-bank finance companies, as you see them in many store outlets and online as well, because phones are not becoming cheaper and people are buying more expensive ones. And that's where the newest features lie, including the latest rage being AI, or artificial intelligence, as Counterpoint researchers Tarun Phatak told me some weeks ago. Now, smartphones actually represent the extremities of desire and affordability in India, perhaps in many countries and maybe more amongst young people. A viral video reported by media last week speaks of how a temple flower seller's son went on a hunger strike for 3 days till the poor mother relented and bought him an iPhone. iPhones, of course, represent the most expensive of smartphones and are also a status symbol. If you are well-to-do, you will carry an iPhone, and so will evidently a child with no income. A smartphone, or iPhone in this case, is not just a phone. It's an entertainment device that you carry and immerse yourself in, whether it's streaming short-form content, long-form content, or just doom scrolling, as many of us end up doing on social platforms. But India's young and aspirational are straining at finances, whether their own or their parents'. IT services company Cognizant was quick to deny a report over the weekend saying that they paid their trainee engineers only 2.5 lakh rupees per year, or 21,000 rupees per month. They paid more, they said, but to engineering graduates. So according to them, that was more than 4 lakh rupees a year, which is more than 33,000 rupees per month. And that went up to 12 lakh rupees per annum, which is 1 lakh rupees per month. But it was true that they paid non-engineering graduates around 21,000 rupees a month starting salary, which was of course no surprise to me or to anyone in the industry. Cognizant's response mirrors what the IT industry has been saying and doing for a while, which is that there is a fair bit of onboarding and training at the company's cost before you become a fully productive employee able to bill clients sitting in the United States or wherever in dollars, obviously. Also, don't forget that of the 1.5 million engineers or so that India produces annually, less than 10% are employable directly, at least by the top IT companies. Bottom line, starting more colleges is not the solution, though that too many education entrepreneurs and business people have discovered and realized already in recent years, and thus converted their college campuses into other ventures. Siddharth Pai, technology columnist, told me a few months ago on the Core Report that starting salaries in IT services companies have barely budged for more than 10 years. And even if you were to assume the best case of inflation, which it is not, you can only imagine how far these salaries can take today's youngsters, or for that matter, anyone. But what has changed in the last decade is that loans are easier to take. One swipe on that smartphone you took a loan to buy will get you instant loans or buy now, pay later loans, even as incomes only creep up. Remember, inflation is eating away both the hopes of the youth and the sense of security of the old, causing both to move their funds to stock markets or even worse, speculative derivative trading and the like. Now, nothing tells me that India can fix its jobs and thus aspirations problems easily, regardless of what political parties might claim. Now, this is a scale problem presented in circumstances we are not in control of. For example, we may want to step up in manufacturing, but we are battling huge factories in China, and more on that shortly, and the fact that we are uncompetitive for a variety of other reasons, including cost of land or, for that matter, finance. Even Bangladesh is more competitive than India and bigger in garment exports. Now, that could also be because they enjoy favorable tariffs from importing countries compared to us, but that's precisely the situation. Few things are in our control today. Maybe if we had opened up our small-scale industries 30 years ago, as I believe we should have, things may have been different, but we don't know that either. India's young need to align themselves for skilling vocations more than thinking that they can train themselves for cutting-edge jobs involving, let's say, artificial intelligence. That's just not feasible. Taking up vocational jobs, for which demand is far greater in India at this point, but also requires a mind and thinking shift. Vocational jobs involve the use of hands, but could also typically pay more. Now, this is not to argue that there are millions of vocational jobs just waiting, but there is surely more demand for them than, let's say, IT services. And hopefully youngsters ought to think and choose that proactively rather than trying for years for government jobs which may never materialize. A good vocational job for which demand will surely rise, like I said, will also help you take less loans or pay out those loans with current incomes and also help you save for the future. And you don't have to blackmail your hardworking mother into buying you an iPhone. And that brings us to the top themes for the day. Indian markets are now rocking to a Wall Street beat. More could come. Oil prices ease off demand worries and reduced war tensions. Indian steel companies are filing anti-dumping cases on Vietnam even as Chinese steel giants announce a harsh winter. Are Indian IT companies posed for a turnaround? And why India's Auto Dealers Federation is asking banks to tighten scrutiny on their own members.
This is the Counterpoint with Govindraj Ethiraj.
Dalal Street rocks to Wall Street. The tide has turned in the world markets once again, and the number of what I call bullish signals from Wall Street is once again at a high. So, and what happens on Wall Street obviously does not remain on Wall Street and spreads to Dalal Street soon as it did last week. So, on Dalal Street, the BSE Sensex and NSE Nifty 50 closed much higher on Friday in a holiday-shortened week. The Sensex was up 1,331 points to close at 80,437, while the Nifty 50 was up 397 points to close at 24,541 on Friday last week. According to a report in the Business Standard, 47 of 50 constituents of the Nifty 50 ended higher, led by Wipro, Tech Mahindra, Grasim, Mahindra & Mahindra, and Tata Motors. In the BSE, 29 of 30 constituents of the Sensex ended higher, with gains led by Ultratech Cement and TCS. In all these cases, gains were close to 4%. And the action on Wall Street. It's rocking once again on Wall Street, which means Indian markets, like I said, will keep pace, give or take. On Friday, stocks were up again on Wall Street as investors closed out on the best week of 2024. The big meltdown that happened just a few weeks ago seems to have been completely forgotten there and here. All indices, that's the S&P 500, the Nasdaq Composite and Dow Jones Industrial Average, are up sharply and are now in sniffing distance of their record highs, which were hit, of course, in July, not very long ago either. Wall Street believes, at least for now, that recession fears were overblown. Data released over the past week has struck the right balance, being not too hot or too cold. CNBC reported UBS's head of investment for global wealth management saying, adding that this should help allay both concerns of a looming recession or that sticky inflation will hamper the Federal Reserve if swift rate cuts are needed to defend growth. Artificial intelligence is now back in flavor for now, at least the chips that go into powering it. Nvidia was amongst the big winners in technology stocks last week, gaining more than 18%. Apple and Microsoft were up 4% and 3%, respectively, according to CNBC. And oil prices are receding some more. Crude oil prices have eased on reports that Qatar told Iran not to attack Israel while Gaza ceasefire talks are ongoing. Brent crude, in response to all of that, is now quoting below $80 a barrel at $79.68, and it had crossed $80 last week. A senior commodity strategist at TD Securities told CNBC that the risk premium appears to be seeping out of energy markets once again, suggesting that traders are curiously disregarding the risk of geopolitical aggressions ahead of this weekend. That was the weekend overnight. And the other overhang, of course, is oil demand from China, which continues to soften, with the Organization of Petroleum Exporting Countries also lowering its forecast for 2024. Much of this, of course, is, as I said, going into the weekend, but nothing much has changed so far. Steel price wars continue. Now, India has initiated an anti-dumping investigation on some steel products imported from Vietnam, according to Reuters, quoting a notification from the Ministry of Commerce and Industry. India steel makers, including Tata Steel, have been publicly railing against Chinese steel coming from China and through what they claim Vietnam. Tata Steel had gone on to say that Chinese factories were running more to keep operations going rather than to make profit. And amazingly, that was confirmed by China's Baowu Steel last week, which produces about 7% of the world's steel, which said that they were facing a harsh winter thanks in turn to woes in China's real estate industry. Reuters says that Indian steel prices have hit their lowest levels in 3 years thanks to increased imports and reduced exports, quoting in turn data from commodities consultancy Bigmint. India, despite being the world's second largest crude steel producer, became a net importer of steel in the fiscal year that's ending March 31st, 2024. Is the mood for Indian IT companies looking up? So, before we get into that, let's start with stock prices, usually a good signaling point. One reason why the stock markets were up last week was information technology stocks, which looked up in turn thanks to US economic data, which allayed fears of a recession or suggested that a recession was not imminent. The Nifty and Sensex were both up 1% last week, and we touched on that already. And the Nifty posted its best session since July 26th, while the Sensex logged its biggest single-day gain in over 2 months, Reuters computed. So, IT here was the top weekly gainer amongst the subsectoral indices, with Tata Consultancy Services, Wipro and Infosys being amongst the leading weekly gainers on the Nifty 50. Now, Indian IT companies, as we know, earn a significant share of their revenue from the United States. So that was the markets or the stock markets, but what are we hearing from closer to the ground? Now, Reuters is reporting that global banks have started reviving the technology projects they put on ice in 2023, which in turn raises hopes for the $250 billion Indian IT sector, which in turn makes about a third of its revenue from banking, financial services, and insurance, or something that's known as BFSI clients. So the latest quarterly reports from TCS, Infosys, Wipro and others show a somewhat small recovery in BFSI client spending and demand after almost 6 quarters of depressed spending since the Silicon Valley Bank collapse, which I'm sure you've forgotten about. Actually, even I did too. Reuters quoted a TCS senior official saying that BFSI should come out faster as they are the ones that went into a caution mode first, who also hoped, that is the TCS senior official, that interest rate cuts by central banks and the end of US election-related uncertainty will boost client confidence. So just to remind you, the interest rate cuts should happen in September by the Federal Reserve, and the election-related uncertainty should end in November when elections happen in the United States. Moreover, there is an evident revival in demand for tech services from big banks such as JP Morgan Chase and Bank of America, who in turn talked of this in their recent earnings calls, says Reuters. JP Morgan said it was boosting its annual tech spending by about $1.5 billion to about $17 billion in 2024, and Bank of America has earmarked $4 billion for new technology initiatives, including developing generative artificial intelligence features. Some of this obviously will flow to Indian companies. The interesting thing is that BFSI recovery could lead the way for other industries and sectors as well. For example, retail, though that's my guess and not something that's mentioned here. The top US banks spend about 7% more on tech investments year on year and 1.2% sequentially, according to the results for their last quarter, said Reuters. The renewed tech investments are aimed at boosting regulatory compliance, customer experience, and cybersecurity, while also revamping infrastructure through cloud migration, according to their earnings calls. And of course, lower interest rates, which could happen, like we've said many times today already, next month will reduce cost pressures on big companies and clients of Indian IT companies. Of course, AI is the new investment and focus area, something that we are continuing to cover on the core report as well, separately, including through a partnership with NASSCOM. Generative AI continues to be a focus as BFSI companies see a more direct benefit since there is considerable retail contact, which AI can perhaps create more efficiency in. Constellation Research CEO Ray Wang told Reuters that most firms convert 19% of their proof of concepts or evidence showing the feasibility of an idea into projects, but BFSI companies convert 31%. Now, to make sense of all of this, you obviously have to go dig deeper, but in general, knowing that BFSI in itself is a big component of Indian IT companies' businesses, that's, I guess, a good sign. Wang says that most companies with a successful AI project will double down and invest in another one. And finally, brokerage Motilal Oswal says it's too early to declare a full recovery. But of course, if you were buying into IT stocks, the question is, would you wait for brokerages to declare a full recovery or go in now? Car dealers struggle with record inventories and are warning banks to warn dealers. Overall, passenger car sales are on a good wicket now, rising almost 11% in July against last year. But that, of course, means that only some car models are doing well and not all. But the larger problem is that car dealerships are sitting on massive inventories, so much so that the Federation of Automotive Dealers Associations, or FADA, feels that banks should lean on their own dealers to not overborrow to stock inventory, which could take time to clear. FADA has also asked the car companies to be vigilant about potential dealer failures thanks to these high inventory levels. The FADA says inventory is now at historic highs of 67 to 72 days, amounting to 73,000 crore rupees or almost $9 billion worth of stock, thus obviously posing risks for dealer sustainability. But the challenges of inventory and the funding of it, a substantial part is underwritten by banks, as we will discover, is as much about the challenges of the auto sales industry as it is about running any business in India. I reached out to Manish Singhania, president of FADA India, which represents over 15,000 automobile dealership, having over 30,000 dealership outlets. And I began by asking him why FADA was asking banks to tighten their scrutiny over car dealerships.
After having almost 14% in the month of July, and a lot of apprehension was already there in the industry that July would not be good for PV industry, but finally we ended up well. And we should always recollect that last year PV has created a lot of new records, and trespassing all those records is very, very difficult when we are doing it in double digit. So July went off well, and in the month of August also, kind of rains dropped in late, I should say. And walk-ins have been good, especially with the dealers and with the brands where the new product launches are happening. All this is in preparation of obviously the festive season. And the only dampening effect in terms of walk-in is the consistent rainfall that we are seeing, or somewhere a lot of places we are seeing flood-like situations and extreme high rainfalls. Obviously, those places get affected by the climatic conditions. But a bit of marriage season also, not much of Murat, but still, till date, in the month of August also, the walk-ins have been good. And YOY growth is also there in the PV segment.
Right. And let me come to the overall dealer liquidity and inventory situation. So you're saying that inventory levels are now between 67 and 72 days and worth about 73,000 crores. And as an institution, you're also saying that this is at an all-time high. So why is that happening?
I would only attribute this, if you look at the PV industry, we are doing such a fantastic job in terms of retail. I mean, the numbers are still rolling in spite of a lot of apprehensions from the industry, but customers are still coming forward. New launches is also driving the excitement in PV industry. The only negative that we can see in the auto industry is the overestimation by the OEM in terms of their market share and their numbers. And that is what is pushing them to build more vehicles to the dealers. They should understand that their billing should be in line with their retails. And unnecessary dumping of stocks with dealers will not bear fruit. So the liquidity challenges is in terms of the banking difficulty that a dealer might face when they are done with heavy numbers or a period of stock of almost 70 days plus. We work on a trans cycle actually, and ideally it is somewhere between 30 to 60 days. And if a vehicle doesn't get rotated within this period, then obviously the dealer starts incurring loss on that particular vehicle. Ideally, we call for a 30-day stop period, but anything above 60 days is like you're losing money like crazy. That's what is the sentiment dealers, the rotation of that, trans period. If you don't rotate, then the penal interest comes in and you start losing more interest, more money in your business. So I think that is where the sentiment as well as the liquidity situation is reflecting.
Right. And that's the survey that anyway, I was going to ask you about. So your survey that asks about liquidity and sentiment, the majority, almost 75%, are between neutral and bad for liquidity as well as for sentiment. But you're also saying that you're asking the Reserve Bank to ask banks to be more stringent in terms of releasing loans to your own dealers. So why is that? Is it because something has already happened and dealers are facing pressures?
Few of the OEMs have started negotiating with the bank, compelling the bank in a way to increase that trans period from 60 days to 20 days or 120 days. So if a dealer with a limited margin, if you have a 90 days paid up stock, if you hold a particular vehicle for 90 days, that means 3% of your dealer margin is what to paying the back to the back interest. So finally, what you have to run a setup, you have to run a business, and you have to make some money out of it so that you can pay your interest, pay to your employees, or pay for the setup. So increasing the trans period will only extend extra burden in terms of stock numbers, in terms of interest that the dealer has to pay to the bank. So for OEM, it is very convenient so that they can, further dump the stocks at the dealership. Rather than that, they should ensure that anything above 45 days if a vehicle is available at the dealership, they should facilitate dealers in all possible way to liquidate that stock so that the rotation is continuous and fast moving.
So, which are the models which are, let's say, staying in dealerships longer than the others?
So right now, believe me, everything is available at stock. Very few models and variants are commanding a waiting period. Also, the new launches for those models, you definitely built up a booking book, order book, and all that. That's a different story. But otherwise, all vehicles are available ex stock.
So, just to ask a more slightly finance question. So, when you say that 73,000 crores is the value of stock that is sitting with dealerships, is that all and mostly funded by the banks?
Yeah, 90% of the stock is funded by banks. It has to be funded by. How can we manage such a huge inventory? That's what I keep on saying that finally, who is earning money? The OEM by selling this vehicle to the dealership, and secondly, financier or the banker who's earning interest on these stocks. And we have to pay all this from a margin.
Okay. So, if you were to look at, let's say, the total number of cars sold in the year and the fact that you're running now at a 2-month inventory, so what is then the ideal, at this point of time at least, what is the ideal production versus supply that what should be the ideal production figure versus the supply figure that we are seeing?
So what has happened actually, if this kind of stock level dealers were able to accumulate just before the festive season, or you say the month of September, it was a very comfortable kind of issue because we have a tendency to accumulate stocks because during festival season, a lot of issues in terms of, logistics, model availability, all these issues come up. So dealers have a tendency to accumulate stock so that if the festive season turns out to be good, that is what is the expectation. So you are able to address all the consumer requirements. And we have a model for or a variant or a color or a sitting combination for every customer available with us. We don't want to lose on that side. But what is sad is this level of accumulation has happened at the start of the most leanest month of the year. So that is the sad part. That is where OEM needs to correct their perspective. They need to understand. They need to recognize and accept this issue and take according correction. And a comfortable, even if they are stressed out, over ambitious, we don't advocate anything above 30 days speed of stock. When you are working in such a perfect supply chain management system, if you go to an OEM factory, they normally keep a 3 or 7 days stock. Nothing above is there. And the supply chain, everything is now normalized. We did have some issues during COVID times and all that. But now everything is normalized and accordingly, they should take corrections.
So, given all of this, given the fact that you're, I'm assuming, sitting with almost 6.5 lakhs of passenger vehicles, more than what your current run rate is, what's the outlook looking like? I mean, how much could the festival season absorb this year's festival season, at least for the next few months?
End of October or mid-November, whenever the festival season gets over, OEM do accept what is the present situation. We are already saddled with heavy stock. So they need to bill. Obviously, they need to bill every month. But they should only build vehicles which are required by the dealers and which are in shortage. Why produce vehicles which are already available at the dealership? Produce vehicle which is not available, but which is shortage. They need to kind of recalibrate or reschedule or replan their production. Every OEM tends to produce a certain quantity of vehicles there. It is their estimation. So why they are going wrong? We have two models which are in booking and which is not available at the dealership. You're not producing more of those models, but you're producing models which are adequately available at the dealership, and still you continue to push those models every month to the dealership. They need to reinvent their production. I know customer requirement, desires, demand is changing very fast and it's very flexible, and they need to reinvent how they can make their production line so flexible enough so they can address the right demand which is coming from the market.
Right, Manish. Thank you so much for joining me.
Thank you. Thank you. Thank you.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.